Things have been changing here in the Danish market, and so has the 5 stocks that I have on my watch list, and some of them I'm actually also buying at the moment. Today I'll take you through a tiny analysis of each of these 5 stocks, but if you want an in-depth analysis of each of them, then make sure that you subscribe to my YouTube channel and go and follow my Instagram. The first company on the list is Pandora, and this is just a great value play right now. Pandora is a retail company that sells jewelry. They are started in Denmark, but they've scaled internationally. This is their website. They make collaborations. They have made right now a Marvel collaboration. They are widely known all over the world. They have like 8.4 million followers on Instagram and do collabs with like famous actors and models and stuff like that. And the company right now is significantly undervalued. So first of all, I want to go here to Simply Wall Street, because Simply Wall Street helps us get an overview over a company. So you can see here on the snowflake, we have a nice green snowflake. This means they check a lot of boxes when it comes to valuation, future growth, past performance, financial health, and dividend. Here are a couple rewards that Pandora gets. So first of all, they're trading 50% below Simply Wall Street's estimates of their fair value. Their earnings are forecasted to grow 10.5%, almost 11% per year. That's a lot. And their earnings grew by 114% the past year. So people have been sent home. The company has done extremely well here the past year. That is of course not sustainable 100% year-over-year earnings growth, but 10% is a great earnings growth, and we're going to use that number in our stock analyzer tool here in a moment. You can see here, actually kind of funny, their main competitors is Apple and Meta. I don't really believe that, to be honest. Like the biggest thing that comes, the thing that comes closest is like the Apple Watch or something, and of course these luxury brands like Hermes, I don't know. So valuation here, you can see that they're undervalued. The fair value is like much above where they are. The future growth is looking great. 11% forecasted annual earnings growth. They have declined their earnings over the past 5 years. They have had this big boom here in like it's 2016, 17, and 18. That their revenue growth, their sales just declined, and the stock price did as well. So I'm not too familiar with the reasoning behind that, but it looks like they have come over that point, and they are just looking to expand massively right now. I don't really want to get into more detail here on Simply Wall Street. I actually want to go here to Everything Money software, amazing software. Go and get it. It's $30 a month right now. Yeah, Everything Money guys, they're on YouTube. Shout out to them. I just bought it. It's amazing. So let's go here to the metrics first of all, because there are a couple things about this company that I absolutely love. And the first being, they have a very low price to sales ratio. That means their revenue divided by their market cap, that is 2.5. That is really low for a company with a forecasted 10% annual earnings growth. They have a dividend yield of 1.5%, and that dividend yield is easily covered by their cash flow, which means it's sustainable. Don't get caught up and buy a company just because they have high dividends, because there are things called dividends traps. They will trap you with their dividends and they can't afford it. 5-year average free cash flow has been 800 million. They pay out $150 million a year. That is easily affordable for them, and that is also why they can afford to buy back shares and blah blah blah. They have an extremely low PE ratio for a company that is a small cap stock. When you're looking at small caps, they will most likely have higher PE ratios because they have more growth. The bigger a company gets, the less potential growth they have ahead of them. So this company is a small cap stock with a $9 billion market cap, and that is why 15 PE is just very low, especially when they are already seeing this amazing growth. So the thing that I actually like most about what we're seeing here, 50% return on invested capital. They are great at utilizing the money invested in the business. So that means when you invest the money, that will actually make a difference. 54% return on equity, and 28% also incredibly high return on assets. They have a 52-week high of 141 and a 52-week low of $82, and right now they are laying to the low side of that. So, well, all this just looks very great. And let's go to the income statement here. We can see that revenue, they have of course had some bad years. That is why we haven't seen an incredible amount of growth here in the revenue. But still, we have revenue growth over the past 5 years, so that's a check mark there. We have down here, they are buying back their shares. You can see, let's go back 5 years, they had 110 million shares, and now they have 98 million shares. They're buying back the shares, and that is great because it is at a low price that they're buying back those shares, which means it actually makes a difference for you. Guys, if a company has 10 outstanding shares and you own one of them, you own 10% of the business. If they buy back 2 of those shares, you still have your 1 share, but that share is now 12.5% of the business. That is why it's important that the company is buying back shares, and also great that they're giving you that dividends, because you can reinvest that dividends and get even a higher stake of the business. Let's look at the balance sheet here. We can see here that their long-term assets covers their current liabilities, and it also covers their long-term liabilities, so they're in a good financial position. And look at the cash flow. We want to see this increasing, of course. They have increased their cash flow, but not a lot. Again, they have had some issues. Let's look at the stock price right here. You can see here they have had some issues with, you know, the stock prices went down here. Why? Because their sales decreased and their revenue decreased, and it's now that they're back on track and started growing again. The 8 pillars, you can see they check all boxes except one, which is their net income growth. Again, because they had bad years, but that is no excuse. It is an X, so it is a 7 out of 8 pillar stock. This company, they have an extremely low PE ratio, lower than the 22.5 PE 5-year PE that we want to see. They have an exceptionally high return, 5-year return on invested capital. They have revenue growth. They have cash flow growth. They're buying back shares. They have bought back 13% of their shares over the past 5 years, and they have 5-year price to free cash flow is 11, so much less than the 20 that we normally seek to get. So let's look at the stock analyzer tool. So here I want to put in my estimates, my assumptions about the future, and that way we can get a price estimate for what should we be paying for the company right now. So here you can see that we have a 10-year that have grown 15%, but you have to think about that last year is baked into those 10 years, so that is of course pulling up the average. So I want to go lower here. I want to get some conservative estimates, and you can see over the past 5 years they have actually not grown that much. You have to think about it's going to get harder and harder to grow a business when it gets bigger. So that is why I want to be conservative, but still this is a small cap stock, so in 10 years, this is 10 years of analysis, 10 years, it is still not going to be like a humongous cap stock. So that is why we can go pretty high on these numbers at still 7, 9, and 11. And for the profit margin, I'm going to go 19 and 20. And for the free cash flow margin, I'm going to go 22, 23, and 24. And for the PE ratio, is a small cap stock, and the PE ratio is extremely low right now. So I would say like a 14, a 17, and a 20. And the price to free cash flow, oh, maybe I should actually pull this down to 13, 15, and 17. Yeah, let me do that. And let me do the same for the free cash flow margin. And I want to go here with the desired annual return of 12.5%, because guys, make it worth your time to invest in these individual stocks, because you could get a 10% return just investing in an ETF. So these assumptions are what I'm going to make about the company. Hit the analyze button. Green, almost, it's just incredibly green here, and I put a 15 PE here. This is actually extreme. I'm actually really excited about buying this company because it just looks like a steal deal here at the moment. Yeah, incredible. If you want a 12.5% annual return, then you should be paying, if you go for the mid here, if you believe in the mid estimates here that I made, you want to be paying $128 for the company. That 12.5% return will be baked into the mix. So that means not only do you get the capital appreciation up to 128, you also get the desired return. So if we want to see what the stock is actually worth, you should probably put in here a 10 instead, because here you get what the company is actually worth. You can see it's probably a double. Oh, I actually put the wrong number in here in the profit margin, so it's even better. basically all green company here, all green stock here, and I'm definitely going to be looking into buying this company. So that was Pandora, and holy smokers, it's looking good. So I want to also just take a look at here recommendation from the analyst, and they say it's a buy or it's a strong buy, and only a couple analysts say it's a hold. So yeah, the recommendation here is pretty clear. They are recommending it a buy, and their price target, average price target, is $900, 900 kroners, and right now it's at 600. The next company that we're going to be looking at is another Danish company. This is Jyske Bank, is what it's called in Danish, a regular bank. You can see here there are other banks, that the Danish bank, and this bank, and there are a lot of banks here in Denmark, but this is the one that I would be buying if I were to buy a bank stock here in Denmark. So first of all, I want to look at some metrics here at Jyske Bank. Financial companies oftentimes have lower PE ratios, lower price to sales ratios, because that is just the sector that they're in. This is but still, we have a price to sales of 2.5, and we have a very tiny market cap. But I still don't know how much like future growth this company has, because they are mainly operating in like Denmark, Germany, and another tiny country that I can't remember what it's called. So they're not really expanding internationally anytime soon, is my guess. So they are going to develop here in Denmark, but there's a lot that they can develop. You know, the Danish bank has gotten some bad reputation here, and they could probably take over some customers, things like that. They have a PE ratio of 7.5, a 5-year PE of 9.5, and their profit margin is high because it's a bank stock, 34%. So you can see they are only getting a 8% return on the invested on their equity. Here in the income statement, we want to see if they are growing their revenue. They have not been growing their revenue over the past 5 years, so that is an X right there. And they are buying back shares. You can see they had 88 million. Now they have 70 million shares, so buying back shares quite a bit. The balance sheet we want to see here, they have they of course have a lot of debt because it's a bank, but actually I want to go over here to Simply Wall Street to look at this. So you can see here Jyske Bank provides a range of financial solutions to personal corporate clients in Olliver, I don't know what that country is, and Germany. Simply Wall Street also thinks that this company is undervalued, but one thing that's interesting here is the financial health, because the financial health is analyzed a bit differently when it's a bank stock. You can see here they check like 3 out of 6 boxes. So they have a lot of debt because it's a bank, but we want to go here down here to the balance sheet. The assets to equity ratio is moderate, but they have bad allowance for their loans, which is a bad thing because they operate so much with their loans. You can see here they don't check having low risk liabilities. They are apparently high risk liabilities, and the loan level is considered good for a financial institution. Taking a look at their cash flow, we want to of course see the cash flow increasing, and you can see it is, because we have 1.66 billion, and that is from 1.5 billion. So they are increasing their cash flow also. If you go to the 8 pillars tab, you can see that they check all their boxes except for one, which is the revenue growth over the past 5 years. That is an X right there. And also we have 2 here that there aren't enough data. But let's go to the stock analyzer tool and put in our assumptions about the future to take a look at what we should be paying for the company. So this last year is baked into the 10-year. I want to go 1, 2, and 3. I want to put in conservative assumptions. And for the profit margin, that has been, free cash flow margin, I'm going to go with, and their PE, I'm going to go with like a 7, a 9, and an 11. And the price to free cash flow, I'm going to do the same thing. So they have had, right now the price to free cash flow is incredibly low because it's a bank stock, and they have had some great success here, printing a lot of money. Want to put in the 12.5% return again, make it worth your while. You can see here we have a green on Jyske Bank. It looks like if you want a 12.5% annual return for the next 10 years, you should be paying pretty much the price where it's at right now, around $54. And the high estimates is 70, the low estimates is 42. So looking at the stock price here of Jyske Bank, you can see that, okay, that is now in dollars, but It is at a high right now compared to like where it has been, but still, I would consider Jyske Bank a buy for me, a tiny buy. I'm not going to throw everything into this company, but Jyske Bank seems like an interesting bank stock in the Danish market. So that was Jyske Bank. Now I'm going to move on to the next one. Royal Unibrew, a brewery, Danish brewery stock, and this is their website. They sell beers. We drink a lot of beer here in Denmark, and the company has recently went down because there are some new regulations possibly taking place here in Denmark, and that is why about like not being able to drink as high percentage alcohol when you're under the age of 18. So that is of course a bummer for the company, but that is now priced in. They went down like 10-15% after those news. Here you can see some metrics. They have a price of sales of 3.5. They have a dividend yield. They pay out pretty big dividends. It's a little bit high. It's like over 50% of their cash flow that they spend on their dividends. So they're probably not going to be able to increase that dividends a lot here the coming years, because then their cash flow would have to increase more. But some good things here: return on invested capital 20%. That is very, very high. Return on equity 40%, also high, and also the return on assets is high. Their PE ratio is a little bit high, and we're going to see that. That is why maybe Unibrew isn't a buy right now, but I would put it on my watch list, and then when it goes down like 10% more or something, I'll look at that with the stock analyzer tool, then it's a buy. So you can see the profit margin of 15. It is a small cap stock again, because most Danish companies are. So let's go to the income statement here and see if they're growing their revenue. 1.3 billion from 900 million. Increasing their revenue, check. Are they buying back shares? Well, they got 52 million in 2017, and now they are buying back their shares, check mark there. Their balance sheet. Have they got too much debt? Well, their total long-term assets is 1 billion, and their total long-term liabilities is 400 million. Check mark there. And their cash flow, are they growing their cash flow? We want to see that. They are right now 216 million from 135 million. Check mark there. Actually from 115 million, because this is from 2020. All those check marks right there. Let's go to the 8 pillars and see. Yes, they got all of the check marks except the value ones, which has to do with the price to earnings ratio and the price to free cash flow ratio. So that is why I'm saying put it on your watch list, because it will probably come down to the level where you are going to be a happy buyer, which I'll show you in a minute. So they have the incredibly high return on invested capital. That should be greater than 9. That is 19. They have revenue growth. They have net income growth. They are buying back their shares, and they have cash flow growth. The only things that are missing are these 5-year PEs. So let's go to the stock analyzer tool and take a look at what we want to pay for Unibrew. So they have grown a bit more the past year, because the whole thing going on and people have been getting back to drinking and stuff. So I want to put in my conservative assumptions here. I want to go 6, 7, and 8. So I think that is fair. We could maybe even go higher, but I'm not going to do that because it's a small cap stock. They have a lot of room to grow, and I'm also going to make the PE ratio high, a little bit higher, because it's a small cap stock. They have a lot of potential. The profit margin, let's just go 13, 14, and 15. And let's go the free cash flow margin. Let's do the same thing. 15. And here, so the company gets bigger, the PE has to be lower, but it's still small cap. So we could probably justify. And the reason for this is, again, we are looking at a small cap. If you look at the Everything Money guys, when they do this, they put a lot lower numbers in here. But that is because they're looking at Microsoft and Apple and Facebook and these huge companies. This is a tiny, tiny company that has a lot more room to grow. So hit the analyze button. Let's see, right now it's a little bit too overvalued. You can see they're all red basically right now. But what I want to do is I want to click here my add to watch list at this price. So when it goes below 75 bucks, I want to get an email notification. That is basically Unibrew for you guys right there. Let's see what the analysts are saying about this company. They're saying it's a buy and a strong buy, basically a pretty high rating here. They think it's a buy right now. Let's move on to the next company, Demant. I don't know how you pronounce that in English. What they do is they make like Demant AS, a hearing healthcare service and audio technology company, develops, manufactures, and sells products and equipment to enhance people's hearing in Europe, North America, and the Pacific, Asia, and internationally. So that is Demant. Let's look at the stock price here. Okay, so we are below the 52-week high, but still we are up there. Nice. Let's look at Simply Wall Street here very quickly. The valuation, undervalued, future growth 7% forecasted, past performance 2% historic, 2% earnings growth. Their financial position, they have too many short-term liabilities. Dividend, they don't pay a dividend, and yeah. So I want to go here to the metrics here on Demant and take a look at it. So they have a price to sales of 3.7. They have a return on invested capital, which is 14, that is high. And they have a return on equity, which is also incredibly high. They have a PE ratio of 27, which is high, but it's still a company with a lot of growth looking forward because it's a small cap stock. So let's go and see if they're actually growing. The revenue is growing. They were under 2 billion and now they're laying at 2.7 billion. And are they buying back their shares? In 2017, they had 256 million shares, and now they have 134 shares. Buying back their shares, check mark there, and check mark to revenue. The balance sheet, let's look at the total long-term assets of 2.5 billion, and they exceed their total current liabilities. No, sorry, down here, the long-term liabilities of under 1 billion. So check mark to the financial position. Their cash flow, are they growing their cash flow? Well, let's see. They grew it from 179 million to 288 million. So they are definitely growing this company. And that is why right here, the 5 pillars, they have a high return on invested capital. They are growing their revenue by a lot, and they have net income growth. They have cash flow growth, massive cash flow growth as well, and they are buying back their shares. The only thing is this price to free cash flow and their P ratio. They are both high. That is why I say put them on a watch list so you get ready when they drop down. This high return on invested capital and this massive growth that they have seen, of course, justifies a bit of a higher PE ratio. But let's see how good this actually looks. So I'm going to go here. I'm going to go 7, 8, and 9. Here I'm going to go 11. For the profit margin, I'm going to go 11, 12, and 13. Also a bit lowballed. And here I'm going to go 11, 10, and 9. And the PE ratio, well, the PE ratio is pretty high right now. I would say I'd put them at 17, 19, and 21. And the same here for the free cash flow margin. And that is why you'll probably see some red numbers here, guys, because they have a pretty high. Yeah. So they are nearing the high estimate here, but I'm going to add it to my watch list for my mid assumptions here. Notify me. Great. So that was Demant. The next company that we are going to be looking at is Novo Nordisk, a Danish pharmaceutical company. Profited the last year because of the virus and vaccines and all sorts of things. This is not a sector that I'm really burning to enter, but if there were one Danish pharmaceutical company that I was going to buy, it would be Novo Nordisk. Not right now at this price, but I'm going to show you my price target for Novo Nordisk later. So Novo Nordisk, as you can see here, they make all sorts of medicine and pharmaceutical things. The stock price skyrocketed here, and it's a much bigger company than the rest of the companies that we have looked at. So let's look at the 8 pillars here. You can see they have a price to sales of 12, much higher than we have seen before, and by far the biggest company that we have looked at today, $250 billion market cap. This is one of the biggest companies in the Danish market. They have a PE ratio of 35, a 5-year PE of 46, and they have a high, very high, which also justifies a bit of the PE ratio. Very high, even higher than on Pandora. 56% return on invested capital and 73% return on equity. Crazy, and the profit margin is also high. The income statement, let's look at it. Are they growing their revenue from 20 billion to 20 billion from 16 billion? Check mark there. Are they buying back their shares? Well, they're going from 2.47 to 2.3. Buying back shares, check mark there. Their balance sheet. Well, they have right now total long-term assets 16.1 billion, and the long-term liabilities of 3.6 billion. Check mark, massive check mark there. Their cash flow, let's look at it. Are they growing their cash flow? We want to see that growing from 7 billion to 7 billion from almost 5 billion. So massive check mark there as well. So it's understandable why they are trading at some higher PEs, but we still want to be conservative when we use the stock analyzer tool. So you can see here they have 2 check marks. Again, the value, the 2 value indicators are red, but you can see they have a massive 5-year return on invested capital. They have also a huge revenue growth, net income growth, cash flow growth. They're buying back their shares. Let's go to the stock analyzer tool and determine what we want to pay for this company. So have to remember that the 10-year revenue growth is baked in. This last year is baked into the 10-year, so that's why we want to lowball it a bit. I would say 4, 5, and 6, because this is not going to help them tremendously grow the coming years. It's not going to be a game changer. This is a huge company, so they are not going to be able to get this growth consistently for the next 10 years that they have been getting the past year. So that's why I'm going to go, but still they have had some great growth. So I'm going to go 13. I'm going to go 14, and I'm going to get my 12.5 annual return, because otherwise, why buy an individual stock? Let's look at the price. Well, this company is also very overvalued at the moment. So that is Novo Nordisk. I would buy it at this, maybe the high assumptions, to be honest with you, because they have been growing incredibly. So still, that is a huge decline from the current price. So most folks would probably say that is impossible. I definitely think that we are going to go down a bit here in the stock price, but who's saying that we are going to hit these numbers that I'm predicting? Analysts' 1-year target is a little bit higher than the current, and analysts are rating it a buy. That was Novo Nordisk. I hope you enjoyed those 5 stocks. I hope you learned something. Put these on your watch list, because they're going to be interesting. I'm going to dollar cost average into Pandora, because I see great value in Pandora right now. A great price that they're trading at. Jyske Bank, I maybe put a couple % of my portfolio into that, not a huge amount, couple % of my portfolio into that one. And Unibrew, when it gets down to my price target, I want to be a buyer of it. Make sure that you follow me on my Instagram. It's Mr. Godvil, MRGODVIL. Go and follow me there. I post things on investing, personal finance, my investing, my life, basically all these things. Go and follow me there, and have a great rest of your day. Bye bye.